Now we're seeing an affordability improvement before we go into the seasonally strong period.
Yeah.
That's a coincidence, I think. Uh, but
I,
even without the big mortgage rate swings,
Mhm.
I do think just based where we are, tied to resale supply and strained affordability, that we would probably still see some more abrupt seasonal shifts.
I want to make another bold call, which I love to do, and I love to be held accountable or celebrate. I'm going to say right now that the Alrighty, folks, in the last 48 hours or so, really the last 30 hours or so, we've seen a lot of activity in the 10-year bond that is transpired into the mortgage market. And I believe I just saw on X, the one and only great Lance Lambert has put out a tweet, or I guess they're still called tweets, that mortgage rates are now 6.62%. Wow. I can't believe it. That is nuts. What's going on?
Yeah. And that is the lowest average 30-year fixed mortgage rate calculated by Mortgage News Daily since May 12th. And I did lose my voice this week. I've been a little sick. But yeah, mortgage rates have come down a lot. Bonds have rallied and yields have come down as the market has kind of come to the realization that we had some type of essentially like a Fed pivot this week. And Jerome Powell had a more dovish tone. If you looked at the dot plots,
I
there was
did.
some members, the median was like 3 cuts for next year, but there were some that were even beyond that, which was interesting. And so the financial markets have priced that in. But a lot of this has kind of been slowly priced in through the year, especially on the stock market side. The stock market, that's why it came up a lot this year. It essentially was pricing in that there wouldn't be as much of a hard landing for the economy. Inflation would decelerate really quickly. And that's at least been the working premise. And so, all of that was like manifested yesterday. And it looks like what happened is that inflation did do the big deceleration over the past 12, 13 months.
Mhm.
And really, it's even a little more than maybe some of the top line numbers suggest if you dig a little deeper.
Absolutely.
And what the Fed has kind of done is they've been patient with it because the economy and the labor market has stayed strong. They've
Mhm.
been able to just kind of like just make sure that inflation isn't going to rear back. And what happened this fall is that the bond market, and I don't know if it was like bond vigilantes, but the bond market had a big sell off this fall and
Mhm.
yields went up. I mean, the 10-year treasury yield hit 10% in October, and the average,
5%. Hit
or
5%.
yeah, five. Yeah, sorry. The
I
average,
got you.
yeah, the 10-year treasury yield hit five in October. And then the average 30-year fixed mortgage rate hit 8.03.
Yep.
And so at that point, when real yields got that far stretched, and that could potentially could push us into a recession if we stayed there longer. And I think the Fed now, having, seen deflation decelerate on that side of their mandate, is now kind of pulling back a bit to kind of make sure they don't, hike for too long
Yeah.
and really push the economy into a recession. And one thing that I thought was interesting was Jerome Powell said at the start that he going into the rate hiking cycle, he always thought it was possible to pull off a soft landing
Mhm.
only because the effects of the pandemic were so unique.
Right.
Um, but you could tell that he, that's what he thought, but he also had like, knew what everybody else knew, which is when you have inflation and you have a rate hiking cycle, usually that leads to a recession.
Sure.
He
Yeah.
still alluded to, that could be a possibility. But
Mhm.
one thing that he said that was unique about this time is that because there was an increase in labor force participation over the past year,
Yep.
a return of immigration,
Yep.
and the third thing he cited was that the supply chain, those issues become unwound. So
Yep.
those three things together, he's alluding to, have decelerated inflation. So why would an increase in labor market participation and an increase in immigration hold back inflation? Well, unemployment is super low. But if you get some softness from the labor market, total labor market increasing, including immigration coming back into the country, that softens it and kind of helps to prevent the
Sure.
wage spikes. And then on the supply chain side, I think housing has played a really big role there. And we've talked about this before, which is during the pandemic housing boom, existing home sales, took off, right? There was a lot of churn in the market. People were moving. A lot of people were leaving places like San Francisco, New York, Seattle, LA, all these places, and they didn't have huge places in like New York, especially. That was my case. And when I moved to Ohio and bought a house, a new construction, I needed a lot of stuff. I had to buy everything to furnish this place.
Hmm.
And so having a housing boom like that, and it was unique because of the pandemic migration,
Hmm.
I think helped to overwhelm the supply chain,
Correct.
including all the stimulus money and the fact people couldn't go do things like
Correct.
international travel and cruises. And so they were spending more of their money on stuff. I think all of that kind of gummed up the supply chain. But I think over the past like 15, 16, 17 months, because there hasn't been a ton of resale housing transactions, I
Hmm.
think that is one of the places where it's kind of helped to loosen the supply chain stress. People are
Yes.
buying fewer fridges, fewer cabinets, all of that stuff, the stuff.
Mhm.
And so I think housing in this, whatever you want to call it, housing downturn or whatever this is, whatever you see it at, this being, I think has played a role if we do indeed have a soft landing.
Yeah, well, let's play that out. Again, you do a lot of stuff. It's Resi Club, resiclubanalytics.com, I believe is the website. People need to go get the free articles. They're awesome. I read them almost every day. One of the articles you put out, I think it was this week, and I think it was Goldman. It might have been someone else. They were talking about expectations for transactions over the next 3 to 5 years. And if I remember the article correctly, they didn't get back to 5 million transactions. This is, of course, existing home sales coming off a bottom of 3.79 until like 2026. Do you remember that article?
Yeah. Yeah. So on Monday, Goldman Sachs put out a new paper that forecasted most of the big elements of the economy through 2027. And they
Okay.
forecasted that inflation would continue to slowly move towards the Fed's target by like 2027. And
Okay.
so the next 3 or 4 years, it would be in between 3 and 2%.
Okay.
And so that staying above the Fed's target, in their theory, I think this is me interpreting their model,
Hmm.
makes it to where yields stay higher, at least on the 10-year side, than we might assume. And
Okay.
so this is interesting, but they had the 10-year treasury yield for next year still at 4.55. And then they had the 10-year treasury
That was
yield
Monday. It's not Monday anymore.
And then they had the 10-year treasury yield for 2025, 2026, and 2027 at 4.5%.
Oof.
So very high because right now it's at what, 4.89 or 3.89,
389. Yeah. 389.
3.9. Yeah. And so what the Goldman was saying yes on Monday when they put out that paper is that they think the market is also getting ahead of themselves, pricing in too many cuts for next year and pricing in too early for March. Well,
Yeah.
today they just came out and capitulated, at least on the March call. They think
Yeah.
now the first Fed cut will come in March.
Hmm.
It is an interesting pushback, though, um, at the 10-year treasury yield. And Bill Gross also yesterday tweeted out that he thinks people for the 10-year treasury yield are getting too far ahead of themselves, thinking it would go to 3. What
Mm.
he said is that he thinks there's going to be a 1.1 percentage point premium of it versus the federal funds rate. So even
Okay.
if the federal funds rate by next year fell to 3 and the market's already pricing that in, then he thinks it would still justify 4 for next year.
Okay.
Uh, but even if he's right, and even if Goldman's right, Goldman still thinks mortgage rates are going to fall.
Mm.
And the reason is they think a lot of it's going to come down to the spread.
The
And
spread's got to come in, yeah. And we've
I'm
seen a lot of that in the last 2 days, right? I mean,
yeah,
it's really
yeah.
starting to come in.
Today's the lowest spread since at least this Silicon Valley Bank failed. We
Mm.
are at 275 basis points. And, you know, there was a long stretch where we kind of bounced between 295 and like, I would even say 310, 315
Yeah.
basis points for a while in the summer.
Yep. I
This,
remember.
the past couple months, we've kind of been every once in a while hitting down to 280, 285, but then sometimes bounce up to 295. So the spread looks like it's coming in a bit. Zandy had thought this cycle that when the spread would really come in is when the Fed starts actually cutting rates.
Okay.
But now that we've pivoted and it looks like March could be the first Fed
Yeah.
cut, you know, these next 3 months could be really big for the spread.
I think I've always said, and I think I've said it with you before, it's the banks have to have certainty the Fed is done. And guess what happened yesterday? The banks got certainty that the Fed was done, in my opinion. And I think that is the trigger for the spread to come in. I don't think they're going to wait for the cuts. The market is always it always anticipates and reacts sooner. It's not waiting for a cut, in my opinion. So, you know,
Yeah,
we'll see
I
what.
think there's a possibility where uh and so I think there's a possibility where inflation stays slightly above Fed target,
Mm.
the federal funds rate stays closer to 3, the 10-year treasury
Okay.
yield will be closer to 4,
Okay.
but then mortgage rates still like closer to 6 or even hitting into the high
Yeah,
5.
you're absolutely right. Yeah, if you get the 10-year at 4, just for round numbers, you could absolutely have mortgage rates at 5.99. Absolutely could
Yeah.
happen.
Yeah. And I think that scenario that I just laid out is kind of like more of what we've already seen and labor holding strong,
Mhm. Yeah,
um, and pretty much the Fed doing what they talked about doing yesterday.
yeah. I think there's a couple more things I definitely want to get in with you. Uh, One belief I've had is rates going below 7 and below 6.5 and below 6 brings back marginal demand. I don't think it brings back marginal supply. I don't think marginal supply comes back until rates are at least sub 5 and maybe sub 4.5. Um, has anybody talked? And where you're going to see this is in transactions. I don't
Yeah.
think you're going to get a big bump in transactions because you don't get the listings.
So what's possible is what you like, let's play out what you had said. And let me add a note. I'm not saying the 10-year treasury yield stays at 4. I'm just
No,
kind
I
of laying
know. I
out
I
that
totally get
logic.
it. Yeah, yeah, yeah.
But
Totally get it.
let's say that right now we've had an affordability adjustment, right?
Correct.
Affordability adjustment is occurring right before the spring selling season is about to begin.
Mhm.
Is it possible that in the next few weeks, months, really more weeks, that
Weeks.
housing, as it moves into the seasonal period, sees a seasonal upward swing? And is it possible, because we have seen some inventory on the active listings build in some of these markets, that
Mhm.
some of those listings get absorbed and that we get an existing home sale report that is higher, looks like we're back to normal, right? Like it pop, right?
Yeah,
And then as the spring selling season goes along and that inventory jump that we saw this year gets absorbed, that
exactly.
that resale transactions come down, but that we also then start to see some of the warmer price month over months. And so that's
We are Lance. We are going to repeat this year that just passed. If you remember the numbers, and you can go look them up, we had a pop in February because of what didn't sell in December and January.
yeah.
Right, February I think popped to like 4.38 or something, and then very quickly came back down to the low fours, ultimately down to 3.79. We're going to do the same thing. The question
And
is, will it be January?
the yeah, the interesting thing about that was when that occurred, we were talking and we had both said that, okay, yeah, that pop in existing is probably warmer than it should be. And then at the same time, the new home sales number was way lower than it should have
I
been.
remember. Yeah.
And we're like, these are probably going to flip. And that is what occurred. So, but then what we did see after that pop, and it was already starting to occur out in the real world, was that there was some more acceleration on the
Oh, the
home
home.
prices. And then March,
Yes.
April,
Yes.
May were fairly warm readings. So I think what's happening in the market is we have a market that is still tight on resale supply, and
Undersupplied. Yep.
it's very strained on affordability.
But getting better.
And and so when you pass through these seasonal windows, you feel it a little more.
I agree.
And the weird thing about this is that mortgage rates over the past 2 years essentially have so during they were lower for the first half of 2022, higher for the second half during the weaker period of the year. Then they saw an affordability improvement just as we moved into the seasonally stronger period of the year. And then this year, just as we moved into the seasonally weaker period of the year, we saw affordability deterioration in 8%
Collapse.
rates. And
Yep.
now we're seeing an affordability improvement right before we go into the seasonally strong period.
Yeah.
That's a coincidence, I think. Uh, but it plays out to where it makes the market feel these more abrupt shifts.
Correct.
Uh, and it's interesting that it's happened how it has. But
I
even without the big mortgage rate swings,
mhm.
I do think just based where we are, tighter resale supply and strained affordability, that we would probably still see some more abrupt seasonal shifts.
Yeah, I think that's fair. And I think mortgage rates roughly falling 150 basis points is going to bring back a lot of marginal demand. And I just said this for the first. I was thinking this yesterday after watching rates today. I'll say it with certainty. I want to make another bold call, which I love to do, and I love to be held accountable or celebrate. I'm going to say right now that the spring selling season just started. I think there's enough buyers who went on the sidelines at 8% that still had the desire that now will come back because they remember the bidding wars of last spring. Last spring, if you were playing first time home buyer, below the median, clean property, bidding wars left and right. I
Yeah.
think there is such a dearth of inventory now that we're going to essentially see the spring selling season do something it has never done, and that is start in late December. It's wild
Well,
for me to think about.
well, I think if you go back and look at some of the data from last year, that's kind of what started to occur a bit was an earlier start to this the seasonal period.
Yeah.
Um, it'll be interesting to see. Now, I think one thing that's happened over the past few weeks is that when I tweeted out, "Hey, what are you mortgage
Mhm.
agents or what are you real estate agents and
I
mortgage brokers?
remember.
What are you guys all seeing?"
Yeah.
And I'm still getting a lot of like not much, some
Mhm.
talk stuff like that. Now, one thing that is true is that mortgage apps are actually still falling. So
Mhm.
the technical resale, what is actually occurring in the market is
Mhm.
falling,
Okay.
but on a seasonally adjusted basis, it's rising. So
Correct.
what's
Yes.
occurring is that the drop in mortgage purchase applications that should occur seasonally is not as big as it would have been if mortgage rates were 8. And so
Correct.
the market is improving as mortgage rates fall. And we're
Mhm.
starting to see this improvement that the seasonally adjusted numbers are picking up. And so
Yeah.
that tells us if this continues, that like you're saying, it could be an earlier start. Uh,
Yeah, and I think the number we'll see this first. You're going to know it a lot better than me, but I'm guessing it's the number that comes out on Wednesday when they talk about weekly mortgage apps purchase and refi. That's probably the earliest indicator that some kind of demand shift has happened. Is that where I should look as an outsider?
so the mortgage purchase apps. So one thing about the mortgage purchase apps, they get sent to us reporters on Tuesday, and then we
Okay.
publish them Wednesday morning. And it's actually the week prior through Friday. So when I say the
Oh,
mortgage apps this week fell, I'm actually wrong. It's not
it's
technically true.
it's the week
So I'm
before.
always a little behind. So
Okay.
mortgage purchase apps that came out this week
Okay.
are probably in the real world, we're probably better off than what we just reported. And then next week, when we show a jump, which I think we will, it will actually not be as big of the jump that actually occurred. So
It'll be the next week. Oh, so
we're a
we're
little bit,
always trailing. I didn't know that. Oh, that's good insight. Okay.
yeah. And the Freddie Mac, so somebody today, when I tweeted out that mortgage rates fell to 6.62, they're like, that's not true. Freddie Mac just reported that the average 30-year fixed mortgage rate came in this week at 6.95. And so after I reported that number, Freddie Mac did publish their number, but the
Mhm.
Freddie Mac number is weekly and
Right.
it publishes on Thursday, and it's an average of the 5 days between Wednesday and Wednesday.
Right. Correct. Yep. I knew that one. Yeah.
So that one's always lagged. And when it catches up to Mortgage News Daily, it will probably be a little bit under Mortgage News Daily because
Right.
it's usually always a little bit less than Mortgage News Daily. But the
Got it.
Mortgage News Daily one's great because it's like a very
Yeah.
timely.
It's a daily
Yeah,
drumbeat. And
exactly.
sometimes it gets reset twice, right? There's a repricing.
Yeah, and I love when they do that.
Yeah, exactly. So again, I think the spring selling season is going to start. We'll look for the mortgage data. I think as rates come in, it brings back the marginal demand. It does not bring back the marginal supply. If we hold to form and we get into the true spring selling season, I don't know what else to think other than we're going to have another couple of warm readings on price.
Yeah, I think it'll be interesting to kind of see what it looks like. One thing that's usually fairly true in housing is that you have a lot of years where they look very similar to the year prior.
Okay.
And you kind of do that for a while, and every once in a while you have a transition year.
Okay.
So 2000 through like '05, if you look at the seasonal numbers, they all look super similar. Like
Yeah.
we kind
Okay.
of like went at the same pace. And then the '08, 12, kind of the same thing, but in a
Mhm.
different way. And then, the 13 through 19, and then 2020 and 2021, very big outliers. But
Sure.
what we have seen this past couple is that it looks like, because resale supply is so tight, when you pass through the spring season, you still get fairly warm readings. And I think that my theory is I think that might have been true this spring, even if mortgage rates stayed at 7. And
Mm.
I think if mortgage rates had stayed at 7 all year this year, including the fall, and didn't get up to 8, I still kind of think that we would have had warmer readings in the spring and still had this
Yeah.
more softness in the fall. And I say that because I think that seasonality is getting squeezed harder because of
Okay.
the it's like a teeter-totter
Mm.
of these or a tug of war of the tight resale supply
Yes.
and
And
this
and
exterior.
affordability. Yeah.
Yeah.
Yeah. Well, this is a lot of fun. I'm so glad you're on the channel. Housing is what you do. Do you want to tease us, or can you tease us in anything that might be coming in Resi Club next week, or is that like a secret?
Um, do I have anything really interesting coming? I'm doing a county map of the remaining, or where we are now versus 2020, March 2020, for home
Ooh,
prices everywhere in the country. So it's
nice.
interesting to see, how many of the places have really taken off. Maine, Florida, some parts of upstate New York, Idaho still really high. Those are the places that I would say have gone up the most in house prices since
Okay.
March 2020. If you did March 2020 to just spring 2020, Idaho and like the Zoom towns would have been the highest. But
Mm,
we've slowly seen Florida catch up to some of those other places. And it's really interesting to see what's happened in like Maine.
yeah.
A lot of,
I guess
lot of
the last thing I'll ask you, because again, you get to talk to all these amazing organizations with their forecasts. Is it fair to say that if rates come down, that many of these people will have to get back busy reforecasting what they see in 2024 and 2025?
I'm gonna be interested to see what the next few look like. Yeah, it'll be interesting. I put out the Mortgage Bankers Association one today,
Mhm.
uh, and that's really kind of lagged, because they published it just before the federal
Yeah.
funds rate.
Collapsed or
Priced
Fed
in.
fund.
So
Yeah. Yeah.
we'll see.
Okay.
We'll see. But at the end of the day, what matters the most is what does the data say and how
Correct.
are the financial markets reacting? I think that's where
Yeah.
we are. It's going to take a little while to see what the housing data is looking like, but we are seeing that, rates fell and that on a seasonally adjusted basis, mortgage purchase apps are rising.
Yeah.
And we are seeing the seasonal fall in inventory and new listings. All this talk about new listings taking off, that has not happened at
Not
all.
happened.
And
Not happened.
really, if you lock at the data, there's still a lock-in effect, very much at
Yeah.
play. I don't
Absolutely.
care what anybody says. The data says there's a lock-in effect occurring in the market, and that a lot of these people who have 3% mortgage rates, uh,
They're not going anywhere.
they, there's not a lot of eager churn in the market.
Yeah. At the end of the day, as I think you've heard me say a dozen or more times, the housing market is broken. It's going to be broken for several more years to come. Lance, where can people find all of your amazing work?
Yeah, you can Google Resi Club Analytics, and when you get there, you can put in your email and subscribe to Resi Club, and you'll get the 5 daily free issues that go out throughout the week. And there's also Resi Club Pro, which is the premium if you want more regional housing market analytics and more stories. And people can also find me on Twitter at News Lambert.
Awesome, man. You're amazing. Thank you for being here each week.